Picture your first paycheck back in 2010. Gas was under $3 a gallon. The iPhone 4 hadn't even come out yet. And somewhere in that paycheck, you had $100 you didn't really need. What if you had put it into the stock market instead of spending it, not once, every single month, same day, same amount, no matter what the news said, no matter how scary the headlines got, just $100 month after month for over a decade? Here's what actually happened to people who did that. And the answer isn't as simple as you'd be rich. It's stranger than that. Let's start with the boring part, because the boring part is the whole point. In 2010, low-cost fund tracking the S&P 500 launched. It let ordinary people buy a tiny slice of the 500 biggest companies in America with one purchase. No stock picking, no guessing which company would win, just the market as a whole. If you put $100 into that fund every single month since then, by the time you'd made about 165 payments, you would have contributed roughly $16,500 of your own money. Take a guess. What do you think that grew into? If you guessed somewhere around $46,000, you'd be right. That's not a typo. Your money nearly tripled. You didn't do anything except show up and not panic. That's the headline. But it's not the twist. Here's the twist. If you had taken that exact same $16,500 and instead of drip feeding it in $100 at a time, you dropped it all in at once on day one back in 2010 and just walked away, you wouldn't have $46,000. You'd have somewhere closer to $105,000. Let that sit for a second. The safe, disciplined, spread it out approach made less than half of what the risky, all at once approach made. Why? Because of when the money went to work. When you invest $100 a month, most of that money arrives late. You think about it. Your first $100 gets a decade to grow, but your 100th payment made near the end barely gets any time at all. On average, your money was only in the market for about half the total time period because you were feeding it in gradually the whole way through. A lump sum, on the other hand, gets every single dollar working from day one. And time, more than almost anything else, is what makes money grow. This is compounding. It just means your gains start earning their own gains. A dollar that grows for 15 years does dramatically more than a dollar that only grows for 7. So does that mean dollar cost averaging? The strategy of investing small amounts regularly is a bad idea? Not exactly. And this is where it gets interesting. Researchers who study this, including analysts at Vanguard, have run this comparison across almost 100 years of market history, not just one lucky decade, and lump sum investing wins more often than not. Roughly 2 out of every 3 times, putting your money in all at once beats spreading it out. That's because markets go up more years than they go down, so the sooner your money is in, statistically, the better. But here's what the 2 out of 3 number hides. The other 1 out of 3 times, spreading your money out saved people from a brutal gut punch. Imagine putting your entire life savings into the market the week before a crash. You don't just lose money on paper, you lose your nerve. And a lot of people who lose their nerve sell at the bottom, locking in the loss for real. Dollar cost averaging isn't really a math strategy, it's an emotional one. It exists to keep you in the game because the actual biggest risk to your money was never the market going down. It's you panicking and pulling your money out at exactly the wrong moment. Most people don't have $16,000 sitting around to invest all at once anyway. They have a paycheck, and a paycheck only lets you do one thing: invest a little regularly, whether the market feels calm or feels like it's on fire, which it turns out is exactly the behavior that keeps ordinary investors from making the one mistake that actually ruins portfolios. So which one is right for you? If you already have a lump sum sitting in a savings account, earning almost nothing, and you can genuinely stomach watching it drop 10 or 20% without selling, the math says invest it now. If watching your account go red for a few months would make you panic and pull everything out, spreading it out protects you from your own worst instinct. And if you're like most people, with a paycheck instead of savings, you're not even choosing. You're already dollar cost averaging by default every time you get paid. Now zoom out from any one decade. Since the late 1950s, the stock market has returned on average somewhere around 10% a year, including dividends. Not every year. Some years it's up 30%, some years it drops 20. But zoomed out across decades, that's roughly the average engine underneath both of the numbers you just heard. That average is also why starting age matters more than starting amount. Someone who invests $100 a month starting at 25 will, almost always, end up with more money than someone who invests $200 a month starting at 35. Not because they saved more, because their money had more years to compound. Time is doing most of the work. You're just the one who has to stay out of its way. This isn't financial advice, and past returns like the ones you just heard don't guarantee anything about the future. Markets can go through long stretches where none of this works out so cleanly. Always do your own research and think about your own timeline and your own tolerance for risk before you put a dollar anywhere. So think back to that first paycheck. The version of you in 2010 who might have spent that $100 on something that's long gone now. The version of you who invested it instead isn't rich, but they're proof of something quieter and more useful than a get-rich story. They're proof that showing up on a schedule without needing to be smart about timing, without needing to predict anything was enough. The market didn't need you to be brilliant. It just needed you to not get in your own way.